Hey guys, Max here, and this is your daily update for yesterday, the 16th of February. Now, there is a bit to talk about, but first, sorry for missing yesterday's video. I had something come up that I had to attend to. And secondly, we're going to be trying out a slightly different format for today. This video is going to be a little bit shorter, focusing mostly just on the markets themselves. And then I'm going to put out a second video later today, looking in more detail at one big story of the day. So we're going to try this format out for a bit. Let me know what you think of it, if you prefer the old style. I just noticed that some people are interested in my thoughts on things like the situation in Ukraine, whereas some of you purely want the finance content. So this format should make it a bit easier for you to pick and choose what you want to watch. And with that said, let's get right into it. So what actually happened yesterday in the markets? Well, for the most part, stocks were suffering for most of the day, but they had a small rally near close and they finished the day pretty much exactly where they started. The S&P 500 closed up 0.1% and the Nasdaq closed down 0.1%, but both indices were down by over 1% for the majority of the day. This volatility was the result really of the Federal Open Market Committee minutes coming out from last month and the fear of an overly hawkish or dovish sentiment from the Federal Reserve, which we will cover in more detail in a moment. In short though, the markets were relatively happy to read those minutes. They weren't too hawkish and so markets rallied a small amount. Bond markets stayed pretty consistent as well because the news from the Fed was pretty much as we expected, so everything was priced accordingly for once. The US 10-year Treasury yield is still sitting above 2%, so comparatively quite high, but in real terms still ridiculously low and very negative. Oil prices have declined a little bit, but they are still high as well, with WTI crude oil sitting just above $90 a barrel still, and gold prices have continued to rise, up another 1% yesterday, now sitting at $1,870 an ounce. Now, in the world of crypto, we've seen a slight decline over recent days. Yesterday saw a 2 or 3% drop across the board. Bitcoin is now sitting at about $43,000 and Ethereum at about $3,000. This is, of course, after the Super Bowl and after every crypto exchange spent tens of millions of dollars on advertising. And I was continuously being told in my comments that crypto was about to explode, as these adverts would drive so many new people into the crypto markets and that we'd enter a new super bull run. But that didn't happen. Prices have actually declined a little bit, still a fair bit higher than they were a few weeks ago, but no super cycle this time around, I'm afraid. This seems to be a case of buy the rumor and sell the news. People buying into crypto as the hype of these Super Bowl ads come around, but then the ads just don't live up to the hype, especially Coinbase's, which was an utter failure in my opinion. Now, the meat of this video is going to be about the Federal Open Market Committee and what was said by the members of the Fed, what their perspectives are last month, and what we can expect from them in the future meetings as well. So what exactly did we find out from the Fed? Well, for the most part, the minutes of the last meeting, they seem to suggest that the Fed mostly just wanted to stick with the status quo, which they had been planning to do before. There has been lots of talk of a 50 basis point or a 0.5% interest rate hike in March, with some officials in the Fed pushing for it quite firmly. But during the committee, this was still not the preferred course of action, and a 25 basis point hike seems to be what the Fed is looking to. Now, regarding the Fed's balance sheet and their purchasing of assets, again, it's more of the same. No changes really are planned. The Fed's bond buying program will continue to slow down at the predetermined rate, and it will stop in just about a month altogether. And then at some point in the future, no one knows when, the Fed will actually start to reduce the size of their balance sheet, so they'll be selling off their assets instead of buying them up. Now, they did stick to the same tune, that the balance sheet will be reduced significantly, but no one really knows what that means at all. The Fed's balance sheet is already absolutely massive as well into the trillions of dollars, almost at $10 trillion, so it will probably take years to shrink it down by any significant margin, and the Fed is still refusing to say anything about that process, when it will start or anything like that, apart from them claiming that it will start once they've already raised interest rates a bit, but who knows when that actually means. Now, this is largely being seen as a good report, good news for the markets, or at least not bad news for the markets, as it was all pretty much expected. There were fears that these minutes were going to be far more hawkish, as following this meeting, Jerome Powell came out and he sounded very hawkish. He talked a lot about how worried he was about inflation and how the Fed might need to change their tune and start acting strongly. What I think we're really seeing right here, though, is the Fed being masters of the markets once more, saying exactly what needed to be said to ensure that market sentiment didn't collapse, which is what they've been doing for months now. We saw the month before this, when the December minutes from the Federal Open Market Committee came out, that behind closed doors, the Fed were discussing things like how bad the inflation situation might get, how quickly they might need to raise interest rates in the future, and how drastically they might have to reduce the size of their balance sheet as inflation soars. And this terrified the markets, and it put us on course for a market correction, the awful January that we saw, where the S&P 500 fell by almost 10%, and the Nasdaq fell by far more than 10%, with some companies like Netflix taking 25-30% hits on a mixture of poor results for themselves and really tough macro conditions for the future. This time around though, it seems that the Fed might have learnt their lesson, and they haven't been discussing how bad things are going to be when they're being recorded, when what they're saying is being written down, and when those notes are going to be released to the markets, to the public in the future. I've spoken a fair bit about this in the past, but I think the Fed has a secret mandate, one that they don't tell people, one that comes from the highest orders of the US government, and that is asset price inflation. They don't really care about inflation all that much, or price stability as they put it. They don't really care about unemployment or job creation as they put it as well. What they really care about is keeping asset prices high, keeping people wealthy, keeping party donors wealthy and politicians wealthy, and just the powerful in general wealthy, because that's where this power is derived from. Everything that we've been seeing coming out of the Fed over the last 6 months, even a year really, has been, in my opinion, perfectly manipulated to maintain confidence in the markets, not in the economy, but in the financial markets, to keep asset prices high and keep people wealthy. Now, one other big caveat behind all of the news coming out from these minutes is that this meeting took place almost a month ago now, and since that time, the inflation situation has continued to deteriorate. It's gotten worse, and what the Fed said back then might not accurately represent what their views are today, and we know for a fact that this is the case for some people in particular, like James Bullard. He has been really spooked by the CPI data coming out, and now he is literally calling for a 1% interest rate hike by July this year, which is a far sharper increase than Powell would like or that markets are pricing in. It's certainly possible that other people in the Fed have been spooked by the CPI data that came out after these minutes, and that they might favor sharper interest rate hikes in the future as well, but we really don't know, and this is one of the downsides of keeping that data hidden from us, keeping what is said in those meetings hidden from us for 3 weeks. Ultimately though, what we see here is just another example of the inefficient markets caused by extremely loose monetary policy. This information is outdated and actually not all that relevant to us today, and yet the markets took it and they ran with it, as it suggested that the music will keep playing for at the very least at least another week or two. Now, the markets themselves should never be this reliant on the minutes from the FOMC, and under normal market conditions they actually wouldn't be. But the financial markets that we see today that are all around us, they are dictated almost purely by the actions of the Fed, not actually the underlying actions and the performances of the companies that make up these financial markets. And that is not healthy, and it's not sustainable either, and it cannot continue forever. Now, I will be coming out with another short video later today. Let me know if you like this format, if it allows you to just listen to the stuff that you find interesting, that you care about, or if you prefer the longer daily updates where I pretty much just ramble about random business and geopolitical issues and markets and everything for about 15 minutes. If you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, you don't have to buy anything, you don't have to hand over any card information, so if that sounds interesting, then make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you'll get from any savings account these days. Just make sure not to use Tether. Thank you all for the support. Thanks for watching. Stay stoic. Until next time.